S&P 500 closing yesterday less than 1% from its all-time high. Joining us now is Monica DiCenso, head of global investment opportunities at JPMorgan Private Bank. Good morning. Good to see you. Does this move make sense to you in terms of investors kind of re-risking, so to speak, and trying to look beyond the conflict in oil prices?
It does. I think what you're seeing is some enthusiasm being pulled forward, right? The assumption that this war dissipates over maybe the next few weeks or a month. And then the acknowledgement that earnings are really strong. We think you're going to see double-digit earnings growth again this quarter. It's a sixth consecutive quarter. That's a big deal. We haven't seen that, I think, over 5 years. And so fundamentals are still really good in spite of the fact there's all this noise. And that's what you're seeing in markets.
We did see, of course, the markets either go nowhere or down 9% over the course of 5 or 6 months as earnings estimates continue to go up at a pretty good clip, led by tech. So that all does make sense. On the other hand, relative to 6 weeks ago, oil prices are higher, so the frictional cost in doing business around the world is higher. We probably either got Fed rate cuts deferred or taken out of the forward curve. And I guess other parts of the world, may suffer a little more than the U.S.
Yeah, and I think the earnings point, well taken. The question now to me is multiples. So if these concerns continue, if oil prices stay high, are people as willing to pay 20-plus times for our earnings going into next year? I think that's the risk, because the earnings story is pretty well documented, and I think it's well understood. Margins are still pretty strong. The other question is the U.S. consumer. They're getting more back in their taxes. That helps to offset some of the higher oil prices. But if oil prices stay here through the end of the summer, I think that eats away at all that benefit. And so that's going to be the debate, I think, over the next few months. And maybe why after this rally you see things kind of trade in a range until we get a little more clarity about how long prices stay elevated.
Yeah, so what do you do now? You've got, do you look at areas where we're still, like Mike was saying earlier, consumer discretionary 7% off the highs, industrials 3%. Our guest the other day said that the Mag 7 was stupid cheap. In a market that's already kind of off to the races again. What do you just go with it?
Two things. I work with clients who were panicked a few weeks ago. This rally is a gift. I say, if you didn't like your portfolio a few weeks ago, this is a great time to reposition and think about maybe moving a little bit out of tech because you're probably overweight. Most people I work with are, and just making sure you have some of those areas that have underperformed. Consumer discretionary, you've got to believe that, again, oil prices come down to help the consumer stay propped up. But I look at an area like financials, still underperforming. And, fairly benign rate environment. We think deregulation is coming. And so that could be a reason to lean in there. And obviously a lot of negative press around private credit. And so, sentiment has been pretty bad there. So I like those sectors where sentiment has been negative and they've underperformed. I'd also highlight healthcare. A lot of people who love the AI story and they're piling into tech. And I said, well, what about all the other beneficiaries? Like, how do you not believe drugs come to market faster with more accurate results? And so you got to look at like biotech and healthcare, I think, too.
You mentioned private credit. You say, it's gotten bad press, clearly. There's a line that says, well, we've been fixated on Iran and oil and all those implications, and yet we didn't, quote, solve either the kind of AI malinvestment story or whether private credit is going to be a festering issue. I would look at it the other way almost, because it's as if we've been digesting it for a long period of time, and it's not as if people have gotten complacent about it. But where does private credit sit in terms of your list of worries?
It should be a concern. I think when we work with clients who invest in this space, this is a higher risk part of the fixed income market. And if you didn't understand that going in, then that's a different conversation. But let's assume you did. I actually think these gates are a good thing. It stops the run on the banks, if you will. And so while it doesn't feel good to see that headline, it helps calm people's nerves and it helps these companies run this risk. And if you're partnering with a manager who's well seasoned and knows how to do this, I do think it's going to be okay. There are concerns clearly in software. And so you want to be careful about having too much exposure to one place. And that's why when I work with clients, if they're putting that incremental dollar to work in fixed income, maybe we look at other parts of that market rather than continuing to pile in. I will say, though, I'm seeing institutional clients add to private credit here. They're using this fear as a time to add. And so that's always something that you want to watch when you see a very sophisticated part of the market saying this is probably a little overdone.
I've been thinking about, there's some who would even go so far as to say, is there something opportunistic about it almost where, these are opaque vehicles that, the retail investor may not perfectly understand. Yeah. They bail, and then kind of the smarter money, quote unquote, is like, I guess it comes back to, can you correctly identify what the underlying is worth? Are these software companies, you're going to go through these filings, and, there's some good names that when I look through, some of the names seem sound, others, you Google these companies and you're like, it's you've never even heard of it.
So I think there's no doubt there's risk in software, right? Yeah. Especially those those investments that were made when valuations were higher. So we know there's probably going to be some write-downs there. There's going to be some risk there. I don't want to say smarter money piling in, right? Because I think it's maybe more patient money. Again, I think there are probably investors who invest in this asset class knowing or thinking they could get more liquidity than they're realizing they can get when these gates go up. And so I think it's maybe a mismatch of people's liquidity needs. And as a result, if you are a patient, longer-term investor and you're investing for the next 3, 4, 5 years, why wouldn't you pick up stuff on a discount?
Yeah, we did get news too. PIMCO, you saw this. They bought all $400 million of an issue, a debt issue of Blue Owl's private credit fund.
Wow,
Yeah.
really?
So they just took the whole thing down, basically saying, we think it's fine. Maybe we'll sell some at better levels. So I guess it points to patient money.
And it's okay if you need liquidity, absolutely. Then you move on, and you haven't seen significant markdown, so it's okay.
Yeah.
But the thing is, you just got to understand what you're getting into. And as these evergreen vehicles have taken off so much, there are probably more people who are investing there, not totally understanding the liquidity profile.
Maybe.